Welcome to China Perspectives, a podcast on the latest economic and credit market developments in China, featuring experts from both within and outside of Fitch Ratings. As the first international credit rating agency to set up an office in China, Fitch offers the unparalleled experience and insights into the market.
Hello, everyone, and welcome to China Perspectives. My name is Jeremy Zook, your host for today's episode, and Fitch's lead sovereign analyst for China. Local government finances have long been a critical issue in China. Over the past several years, challenges in the local government financing vehicle, or LGFV sector, and local government sector have become more acute in the context of declining property-related revenues, slowing nominal GDP growth, and ongoing fiscal spending needs. Last November, the central government formalized a program to support local governments in resolving some of their hidden debt burdens through debt swaps, or debt substitution, as Fitch often refers to it, in essence providing a sort of a bailout to the LGFV sector. In today's episode, we'll discuss the progress being made towards resolving many of these LGFV hidden debt risks over the past couple years, the impact on LGFV and local government finances, and lingering medium-term risks. Joining me today to discuss these issues is Davis Sun. Davis is a senior director in Fitch's international public finance team based in Shanghai, covering LGFVs and local and regional governments. Davis and his team have recently published a report exploring in detail the implementation of the debt substitution plan, so this should prove to be quite a valuable conversation. Davis, thank you for joining us today.
It's my pleasure, Jeremy.
Maybe we can start, Davis. For our listeners who may not be as familiar with some of the recent policy developments around LGFVs, could you start with an overview of the debt substitution program as it was laid out by the government in November 2024, and kind of what conditions necessitated the recognition of these somewhat high levels of hidden debt from LGFVs?
Yep, of course. To start with, I think this is not the first time that the central government rolled out the debt substitution program. The first round of the program actually started back in 2015, which also marked the first round of the local government debt issuance. So the spirit for the debt substitution is actually very simple. In the past, local governments face structural fiscal gaps. So they need to, set up the LGFVs to borrow on behalf of the local government to invest in policy projects, roads, infrastructures, etc. But these projects, as we know, they don't have income, they don't have operating cash flow. It is the local governments that requested the LGFV to borrow on their behalf to invest. So in the past, since 2015, there have actually been probably 3 rounds of debt substitution. The first round is the biggest, amounts over 13 trillion from 15 to 18. Then the second round will be more selective from 2019 to 2023, probably less than 1 trillion per year, specifically to different regions. So this round, I will call it the third round of debt substitution program, is probably the second largest in size. So the amount announced is 10 trillion, and the 10 trillion will last about 5 years. So for the first 3 years, namely 2024, 2025, and 2026, it will be around 2.8 trillion per year. And then for the last years, it will be just cut down to 800 billion. So because of this, the MOF, the Ministry of Finance, actually disclosed that the debt substitution program actually have been cutting down the so-called hidden debt, which is the debt raised on behalf of the local government, down to around 10.5 trillion by the end of last year, which is 2024, from 14.3 trillion by the end of 2023. So this is basically the spirit and the basic structure of the program. And in return, why we're calling it substitution? Because it's basically using the special purpose bond that's issued by local governments to repay the outstanding debt on LGFV's balance sheet. So basically, it doesn't change the overall debt amount of the entire local public sector. It's just a migration, or we call it debt crystallization. That's, we're moving the off-balance sheet debt onto the balance sheet of the local government. And you also mentioned what necessitated recognition. Well, this is somewhere that's in the gray area because the MOF did an investigation on how much, what is the actual scale of the hidden debt back in 2018. But that amount was never disclosed before 2024. So basically, the 14.3 trillion of hidden debt that's disclosed for end of 2023 is the official recognition. But in Fitch's, in our universe, we actually think the actual amount of the hidden debt will be larger. It will be larger than the official number that's disclosed by the MOF. And we may touch upon these issues as we go on.
Thanks for the very, very helpful overview. Lays out a very good background for our listeners. In terms of this most recent debt substitution program, how do we view that as progressing so far? And I know in your report that you talk about kind of how specific provinces are utilizing these programs. Any kind of details to highlight in that regard?
Yes, of course. I think the program, we are now in one of the three peak years, right? 2025. So from 24 to 26, the amount of the substitution will peak at 2.8 trillion a year. And so far, we've seen that it has been progressing as planned. But we see that one of the most critical demonstration of the program is that it is uneven. It's asymmetric. Not all the provinces get the same share. So put it in this way, China is very asymmetric in development and also the debt size, the GDP size. And what we find out is that the quota, that how the debt substitution quota is allocated is actually disproportionately relative to the outstanding LGFV debt of all the provinces. And one key feature is that we see the quota is actually skewing towards smaller and most likely the economically weaker provinces that need more support. So if you're looking at China's map now and you draw a line between, you can see that the provinces on the west part of this line, most likely on the peripheral of the economic activities and far from the coastal, more developed economic centers, they have relatively small and lower outstanding LGFV debt. But if we look at how much the quota they get, it's actually much higher than national average and also much higher than the coastal provinces, which are much larger in size. I'll give you two examples here. So we actually classify the bottom 10 provinces in terms of the LGFV debt. Name a few like Shanxi, Gansu, Jilin, which are typically in the northeast part of China, northwest of part of China, and southwest part. So these bottom, we call it the smallest 10 provinces. They only cover less than 5% of national LGFV debt. But the quota that they are set to receive from 2024 to 2028 actually covers 65% of their outstanding LGFV debt. So that is a much higher number than national average, which is only less than 20%. On the other end of the spectrum, if we look at the five largest and the most developed provinces, namely Jiangsu, Zhejiang, Sichuan, Shandong, and Guangdong, they account for over half of the national LGFV debt. But the quota they receive for these 5 years only covers around 8% of their outstanding LGFV debt. Especially for those provinces like Guangdong, they actually have declared that they have no hidden debt anymore, so they receive no quota at all. If we talk about the spirit, what is the motivation behind this very skewed distribution is that we think the central government is trying to focus the fiscal resources to control the spillover risk from these less developed regions, because these regions were the places where most credit incidents on the LGFV sector occurred. So fiscal resources were, quite strategically channeled towards these provinces to fix the issue, to repay the debt so that the debt burden on the LGFVs would be lowered. Same on the local government. But on the more developed regions, I think the policy will still prioritize economic stability and also the overall advancement of the strategic focus of the country.
I want to build off the point that you made on the program being geared towards limiting spillover risks in the LGFE sector. How do we view the impact of this debt substitution plan on the overall financial health of the LGFV sector and the degree of risk in the sector since the implementation of this program?
Yes, that's an excellent question. To start with, let's touch upon the ratings. So for most of our rated issuers, especially for the LGFVs, who most of them will receive the debt substitution program to some extent, we do not expect the program itself will translate into rating upgrade or positive movement because these has actually been captured in our assessment in the government rated framework because we do believe that these hidden debt will ultimately be supported by the sponsoring government. However, having said that, we do have observation that, the debt substitution may lead to improvement in the standalone credit profile, which captures the, financial profile of each standalone LGFVs. The reason for that is, the debt substitution program literally reduces the outstanding debt on LGFV's balance sheet. And because of that, it may lead to an enhancement or improvement in its leverage and coverage ratios. And this will ultimately drive some upgrades on the standalone credit profile for some issuers. We actually have seen a few cases for the past months that the SCP, the standalone credit profile, has been raised because of the debt substitution program. So that is on the rating side. On the sector in general, we have observed that because of the program and also the orchestrated, monetary administrative measures taken in orchestration, the average credit spread on the onshore LGFV bond have also narrowed quite meaningfully in the past. We see that the credit spread narrowed by around 150 beeps nationwide from 2023 to 2025. And among the narrowing of the credit spread, we see that the same uneven pattern that's quite aligned with how the quota is allocated. And also that echoes to your question on spillover risk. So if we look at the 10 smallest provinces, which are less developed, we see the tightening of the credit spread is actually much greater than the drop in the largest provinces. It's more than double in terms of the tightening of the credit spread. This actually shows that the entire orchestration of the debt relief package that's delivered to the LGFV sector actually has been perceived well by the market. And lastly, I think it's about the overall risk in the future. I think now the central government is actually doing an orchestration of a package of the support, including the fiscal one, which is the debt substitution program, the monetary one, which aims to lower the cost of debt in general, and also the administrative one, which mainly look at the refinancing policy on the LGFVs. So these package of debt control measures will continue to take effect in the coming few years.
Relatedly, what impact is this program having on fiscal position of local governments themselves? I mean, is this providing some fiscal relief to local governments, even as their explicit level of debt is rising?
For Fitch's calculation, we have been looking at the general debt obligation of local governments in two folds. One is the on-balance sheet local government debt, which are the general purpose bond and the special purpose bond. So that's one thing. And we also look at the contingent liabilities, which mainly include the hidden debt. And as I mentioned, our calculation, our definition of the hidden debt, is larger than the official disclosure because we do believe that a larger amount of the debt on LGFV's balance sheet are serving the entire purpose of policy investment. So if we consider this, then you will come to the conclusion that the debt substitution is mainly a migration of debt responsibility from LGFV to the LRG, but it does not reduce in any way the overall level of public sector debt in our definition. However, we do see that on the positive side, it does save interest because the special purpose bond carries a much lower interest cost than the outstanding LGFV debt. We think it's about 3% in general. So 5% is the average cost of debt on the entire LGFV debt on a national basis. and 2% is the latest issuance cost for this special purpose bond. So we actually did a rough calculation. It will save around slightly over 1 trillion of interest expenditure for the public sector from 2024 to 2028. And the second benefit, I think, is also it reduces the pressure for local governments. And that refers to, the fiscal relief that you mentioned, because in Chinese context, it is the local government's responsibility to repay all this outstanding hidden debt as defined by Ministry of Finance. But before the rollout of the 10 trillion program, the local government would need to rely on its own fiscal revenue to service this debt. And that will be a pretty large chunk of the operating revenue as well as the capital revenue. But because of this program, it actually increased the debt limit that the local government can use. So it actually reduces the imminent pressure from the local government to service this hidden debt or to migrate this hidden debt on its own balance sheet using its own fiscal revenues.
Another integral part of the debt substitution plan was trying to limit the further growth in hidden debt from LGFVs in order to try to mitigate some of the future risks. What have we seen since the implementation of the program around LGFV debt growth? And then how do we view kind of the lingering medium-term risks with respect to LGFV debt?
Yes. Historically, if you look at the 10-year horizon, we can see that the LGFV debt has been growing quite fast. We see the CAGR for the past 10 years, the 14 to 24, is around 15, 16%. So that's very high. But because of the program, it actually take away the debt. So we see in 2024, the LGFV's asset and debt growth has come to a historic low level. Asset growth is around 6.3%, and debt growth is only about 3.3%. So that is the lowest growth level that we have seen in past decades. So we can see that the 2.8 trillion actually has been taking some effect on the growth. But if we look forward, we see that the debt substitution is just one thing. In tandem is the regulation on LGFV financing, because the key spirit for the central government is to control or to limit the possibility for further debt migration or the possibility of further debt crystallization. So we see that LGFVs have been facing probably the more restrictive measures to issue new debt to fund new investment. So that has also contributed to this historic low level of debt growth. And one data that we can show is we see the net LGFVs bond issuance actually has declined quite drastically in the past 2 years. So the net issuance was around 150 billion in 2024, but it was over 1.3 trillion a year ago. If we look at 2025, we actually see it's not increasing anymore. So the entire LGFV bond issuance has actually been reduced by over 100 billion this year. So I think, both the debt substitution program and the control measures on which and how LGFV can issue bond and get new debt play in tandem in the overall debt control. And if we look at more long-term how the risk will evolve in the coming years, I think that one of the key driver for potential increase in this hidden debt, or we call it local government's contingent liability, is the weak debt service capacity of LGFVs. We did a calculation, if we extend the overall maturity of all the LGFV debt to 15 years, because they are long-term investment in nature, then we see the synthetic debt service coverage ratio, which means how much of its own debt can be serviced by its own operating cash flow, or EBITDA, is only about 0.42 times. That means a funding gap of about 34 trillion Chinese yuan that cannot be covered by its EBITDA. If you look at the numbers, the 10 trillion will only address about 30% of this 34 trillion funding gap. And that would leave over 24 trillion of the funding gap on LGFV's balance sheets unresolved by this program. So we can articulate that, because of this 24 trillion funding gap, so this may not be the last round of debt substitution that will be carried out by the central government. And if you watched the recent Central Economic Conference that took place a few days ago this week, we also noticed that the central government mentioned for the first time that they will also take measures to address the non-hidden debt portion, which in Chinese context, they call it commercial debt. So in general, I think the policymaker is aware of this issue. There are still a large funding gap, and this gap is the result of the underestimation of the hidden debt in the past. I think that will be the key medium-term risk that we will be facing for the sector.
Certainly a lot of challenges to kind of keep an eye on and things to watch over several years. I suppose there's been, some discussion that local governments have been using their special purpose bond proceeds kind of beyond the debt substitution quota that they were allocated over the past year. And, in turn, that seems to be limiting the level of the special purpose bond quota that is being used for infrastructure development. And then this has kind of contributed to a bit of the sharp slowdown in fixed asset investment that we've seen in the past several months. But what's your take on this?
Yeah, I'll say it's twofold. I think one is we talked to many issuers that we cover, and it seems that there is a strict use of proceeds regulation on the special purpose bond. So if they are, for debt substitution, then it will be for debt substitution. If it's for new investment, then it will be for new investment. But we do see there could be some quota reallocation or quota reassignment for the unused ones. We see, since October, there are already being announced that for the unutilized debt quotas for local government, it can be reassigned for different purpose. So they reassigned about 500 billion of the unused quotas by end of the year. Around 300 of them will be for debt substitution related EOP, and the rest 200 billion will be for new investment. And the second is more general in nature. I think for FAI, of course, it has been takes a lot of market attention in the past month. But if we look at the large number, yes, the first 10 months down around 1.7%. But we see that probably a large chunk of the drop is potentially due to real estate drag down in investment. The real estate actually down by close to 15% year on year. And the official number says the real estate actually drags down the overall FAI growth by 3 percentage point. And for the local government, I think the local government's capex is only part of the national FAI that we see. So in general, I think, yes, China has been trying to moving away from the infrastructure investment-led model. And if in the future there will be fiscal stimulus, there will be a rebalance of boosting consumption and also more targeted infrastructure spending.
I think you make a very good point on statistical issues around the calculation of fixed asset investment, especially related to real estate. I want to turn maybe briefly to how we see the outlook for 2026. Will local governments continue to kind of be constrained by the ongoing LGFV debt substitution and, somewhat subdued revenue collection? Or do we anticipate that we might see a bit of a recovery in local government finances?
Yes, that's a good question. I think we just published our 2026 outlook report on both the local government sector and the LGFV. I think the central government will still adopt a proactive fiscal policy as confirmed by the recent Economic Work Conference. We think in our base case, we assume that the 2026 LG debt growth and capex growth will be at a similar level to 2025. So the same amount of 2.8 trillion for debt substitution and around 4.4 trillion of new SPB for new investment. And we also expect, there could be moderate increase in central transfer, and also there could be moderate increase in the overall special purpose bond quota for new investments. So for the next year, it is still the peak year for debt substitution. So the debt substitution of 2.8 trillion would still account for around 40% of local government bond growth next year. So as we mentioned, I think the fiscal stimulus will be more selective in nature. We see in the first 10 months, discretionary expenditure, which could be more related to capex, the FAI in nature, has been declining. For instance, the urban and rural development down by 7%, rural and forestry, water utility down by 11%. But the growth in general local government expenditure are more driven by the more staple expenditures such as social security. So taking into account of the rebalance between the consumption and investment, Our view is that the fiscal stimulus next year will be more rebalancing and to boost probably income and consumption, including the subsidy on purchase and more, targeted FAI, such as the manufacturing infrastructure, high-end industry upgrade, renewable energy, etc.
Great. Thank you, Davis, for joining us again today and for your insights. This has been an incredibly informative conversation. And of course, something that we'll continue to focus on in 2026 and over the next several years as well. I would encourage our listeners to have a look at the recent October report from Davis and his team for more details on the impacts of the debt substitution program. And of course, as always, keep an eye out for future research on LGFVs and other China-related topics, which you can, of course, track on our website. Thank you, everyone, for joining us today for this episode of China Perspectives. This is our last episode for 2025, so we wish you a happy and healthy start to the new year ahead.
You've been listening to Fitch Ratings China Perspectives podcast. To learn more about our ratings and research on China, visit us at fitchratings.com. Subscribe to China Perspectives wherever you get your podcasts.